So this was the week where it felt like the entire market just held its breath. On the surface, everything looked pretty quiet, pretty calm, but underneath all of that, a storm was brewing, and you could feel the pressure building to a breaking point. Let's dig into what really happened.
This quote from investing.com just nails it. The market was coiled up like a spring. That quiet start to the week, totally deceptive. It was hiding the potential for some absolutely huge moves because a perfect storm of economic and political news was about to hit all at once.
And that's the big question here, isn't it? How on earth could one short holiday week pack in more high-stakes drama than we've seen in months? What was the spark that caused everything to escalate so quickly?
Okay, so here's our first clue that something was really off. Take a look at the S&P 500. That's the broad market, right? It barely moved. But then you look at the VIX, which is basically the market's fear gauge, and it spiked by almost 10%. That is a classic disconnect. It means while prices look stable, underneath, fear was absolutely surging.
And what's so weird is that this growing anxiety, it wasn't coming from the big economic picture. I mean, come on, the fundamentals looked rock solid. The latest numbers for third quarter GDP confirmed the economy was expanding at a really robust 4.3%. That's strong.
And what about inflation? The market's #1 obsession for the last couple of years? Well, the Fed's favorite inflation gauge, the PCE index, was just holding steady. Yeah, it was persistent, but it was predictable, coming in right at 2.8%. No real surprises there.
So you just have to ask yourself, if you've got a strong economy and stable inflation, what in the world was spooking investors so badly? Well, the answer wasn't hiding in some economic spreadsheet. No, it was playing out live in the high-stakes world of global and domestic politics. The first shockwave, the first real source of all this fear, came from an international showdown. It started out as kind of a diplomatic curiosity, but it blew up into a full-blown economic threat. People were calling it the Greenland Gambit.
And this whole crisis, it unfolded like a roller coaster. It kicked off over the weekend with the sudden threat of a 10% tariff on 8 European nations, weirdly tied to buying Greenland. By Tuesday, that threat had triggered the market's worst sell-off in 3 months. Then, just as fast, by Wednesday, some vague announcement from Davos about a potential deal was enough to calm everyone down. Wild.
And look, let's be clear, this was no small skirmish. The proposed tariffs were targeting over $360 billion in imports. And Europe? They were ready to hit back, threatening $110 billion in U.S. exports. This wasn't just a threat, it was the potential beginning of a massive, costly trade war.
Now, as if the trade drama wasn't enough, there was a second shock brewing right in Washington, D.C. And if that trade threat created uncertainty, well, this next crisis struck right at the very heart of the U.S. financial system.
And at the center of this whole new crisis was a single number: $2.5 billion. That was the estimated cost to renovate the Federal Reserve's historic headquarters. Something that's normally a pretty routine thing suddenly became this massive political flashpoint.
So you basically had two completely different stories being told. On one hand, the official story was that the Department of Justice was opening a criminal investigation into Fed Chair Jerome Powell's testimony about the renovation. But the political read on it, that this was a totally unprecedented attempt to pressure the Fed for not cutting interest rates fast enough.
And Chair Powell, he did not mince words. He came out and basically framed the whole investigation as a direct attack on the central bank's independence, arguing that it was retaliation for making policy based on data, not on political demands.
This insane amount of pressure immediately lit a fire under the race to see who would succeed Powell. It quickly became what traders were calling the Battle of the Kevins, a showdown between former Fed Governor Kevin Warsh and an administration insider, Kevin Hassett. And as the week went on, the odds just started to shift dramatically.
You could actually see this playing out in real time on prediction markets, where people bet on future events. The odds for Kevin Warsh shot up to 59%, mostly because he was seen as the guy with established market credibility. Meanwhile, Kevin Hassett's chances cratered to just 16% because he was seen as being too politically compliant after defending the investigation into Powell.
So after a week filled with trade threats and these institutional crises, what does it all mean? What's the big lesson we should take away from this absolutely chaotic week?
It all really comes down to one core concept: the political risk premium. Basically, it's when investors start demanding to be paid more to hold assets, Not because the economy is weak, but because they're genuinely worried about political instability and policy uncertainty.
And this wasn't just some abstract theory. We saw it get priced into the market in real time. The yield on the 10-year Treasury bond, which is a key benchmark for borrowing costs, it rose to its highest level in months. And this wasn't a reaction to inflation data. It was a direct reflection of the fear that the Federal Reserve's independence was actually at risk.
And that leaves us with a really critical question for the future. We're always told to diversify our investments to manage risk. But when politics becomes the main thing driving the markets up and down, it raises a really tough thought. Is this the one risk that touches everything? The one risk that maybe you just can't escape?